Amalgamation of companies. Amalgamation refers to the process of merger of two or more companies into a single entity or where one company takes over the other by outright purchase. When two or more companies join to form a new company, it's amalgamation. Absorption and blending of one company by the other is absorption. Amalgamations are done to increase the economies of large scale production, avoiding competition, increasing efficiency, expansion, increase in the market share, etc. Here we have two companies, that is vendor or transferor company and vendee or transferee company. When two or more companies are wound up and a new company is formed to take over their business, it's called as amalgamation. At least three companies are involved, only one resultant company is formed. Amalgamation is done to cut competition and reap the economies in large scale. In absorption, an existing company takes over the business of one or more existing company. At least two companies are involved. No new resultant company is formed. Absorption is done to cut competition and reap the economies of large scales. In external reconstruction, a newly formed company takes over the business of an existing company. Only two companies are involved. Only one resultant company is formed. Under this form, a newly formed company takes over the business of the existing company. External reconstruction is done to reorganize the financial structure of the company. AS 14 Accounting for Amalgamation recognizes two types of amalgamation: amalgamation in the nature of merger, amalgamation in the nature of purchase. Amalgamation in nature of merger, there is a transfer of all assets and liabilities. Equity shareholders holding 90% equity shares in transferor company become shareholders of transferee company. Purchase consideration is discharged wholly by issue of equity shares of transferee company, except cash only for fractional shares. The same business of transferor company is intended to be carried on by the transferee company. The assets and liabilities taken over are recorded at their existing carrying amounts except where adjustment is required to ensure uniformity of accounting policies. Journal entries for recording the merger are passed by pooling of interest method. Amalgamation in the nature of purchase, there need not be transfer of all assets and liabilities. Equity shareholders need not become shareholders of transferee company. Purchase consideration need not be discharged wholly by issue of equity shares. The business of the transferor company need not be intended to carry on by the transferee company. The assets and liabilities taken over are recorded at their existing carrying amount or the basis of their fair values. Journal entries for recording the purchase of business are passed by the purchase method. Para 3 Clause G of AS 14 defines the term purchase consideration as the aggregate of the shares and other securities issued and the payment made in the form of cash or other assets by the transferee company to the shareholders of the transferor company. The amount paid towards equity shareholders and preference shareholders is only considered as the part of purchase consideration as per the definition of AS 14. If certain liability of the transferor company has not been taken over by the transferee company, it will be discharged by the transferor company. The methods for computation of purchase consideration. Lump sum method. Under this method, the transferee company agrees to pay lump sum or fixed amount to the shareholders of the transferor company. Net payment method. Under this method, the transferee company makes individual payment to the equity shareholders and preference shareholders, either by way of cash, issue of shares, and debentures. Net asset method. Under this method, purchase consideration is derived based on the value of assets less the outside liabilities, excluding share capital and reserves taken over by transferee company. As per AS 14, the value of the assets and the liabilities shall be at the value as agreed between the two parties. If there is no value agreed, then assets and liabilities taken at the book value. Intrinsic value or share exchange method. Under this method, the purchase consideration is calculated at the intrinsic value of shares of the transferor or transferee company. The ratio of shares to be issued is computed and multiplied with intrinsic value. Total share capital of the transferor company shall be divided by the total number of shares.